In this video, as part of the Candlestick School series, we're going to look at the inverted hammer. Interesting one this, stay tuned. Hey traders and investors, a very warm welcome to you. Okay, so inverted hammer, let's get right down to it. This is an interesting one. You'll see why in a second. Okay, so inverted hammer is basically a hammer that's inverted. So if you see what a hammer is kind of looks like a hammer, really. That's why it's called a hammer. It's probably the only common sense candlestick name we have out there. That's our hammer. You know, we've got a hammer head basically, and then we've got a handle, so to speak, and we normally see that at lows, which would indicate, hey, we've got pressure coming down that's been reversed intraday, and we've got potentially a reversal. Now, oops, I've deleted the whole lot. Never mind, let's do it again. The inverted hammer is a hammer, an upside down hammer, basically. So we've got the excuse my drawing, but you get what we're talking about here. We've got the body and we've got the handle to the upside, and this happens at lows. Now, the astute of you, or the guys of you who kind of watch the videos, are going to say, hang on a second, that doesn't look quite like a bullish reversal. Let me put this into context. This isn't as powerful as, let's say, a hammer that pushes through, in my opinion. You know, some people may disagree, but that's what trading is all about, isn't it, guys? This is potentially a precursor for interesting reversal. Now let me show you what I mean, because if you think about what's happening here, so the body of the candle is down here, and maybe we should redraw it a little bit so we're a little bit clear of what's going on. You know, this is our body down here, this is our intraday trade as a high. So we have a scenario where, you know, let's say we're at the lows of the market and we've kind of to push up, we failed and we pushed back down. You might say that's bearish, and actually if that was at highs, you probably are quite bearish. But this is something different. This is a bullish pattern that happens at lows. So why is this bullish? This is bullish because it may be giving you a little bit of insight that there are some buyers around. Okay, so this is not like, hey, we're going to go crazy on this. This is the most bullish pattern ever. This is something that just pops a little flag up that says, hey, if you're short, be careful. If you're looking to go long, let's look for something else to confirm. So this, to me, in my opinion, is a first stage filter, or initial filter, or second filter. It's not a final trigger candlestick. Hey, I've seen it, let's go. To me, it's like stacking up the reasons to go long or to cover that short. That's what this is to me. And so you've got to put it in that context. And so let me just sort of kind of go over the ways that we could enter this that allows us to take that into consideration. Okay, so first thing is we have, has to be at lows. You know, we've come down, not necessarily at multiple trend lows, not necessarily kind of right at stretch lows, although that will offer a good indication. I've got an example in a second of when that happened and kind of give you an insight as to something that might happen. But when we're kind of at a lows with the last few weeks or few months. So here's an example here. Okay, it's on the Dow, it's on the cash Dow. We've got one here. Now, really strictly speaking, and this is probably not going to be a textbook one. I've got a textbook one in a second to show you, but you know, the world doesn't always, unfortunately the markets don't always give us the textbook scenario, but it's still something to be aware of. Really, this kind of distance between there and there should be twice the distance between the body. So the body distance of say 10 pips or 15 pips, that's got to be twice that in theory. So that might not quite qualify that, but I've got some in a second that will show you that definitely do qualify. But as an example, you know, you wouldn't just go long on the close of this, you would want to see what happened on day 2. That's the key to this, guys. Take anything from this video, it's waiting for day 2 after you see the inverted hammer, because day 1's not enough. Day 1's just a clue, and often on day 1 it will get an inverted hammer and it will carry on going lower, and it doesn't matter because as long as you haven't pulled the trigger on it, you're going to be okay. So there's a good example here. If you took it on day 2 when it broke the high, for me that's the trigger. That's got to be the reason you take the trade. When it breaks the high on a second day or third day, I'd be cautious about taking it 4, 5, 6 days, anything past 3 days. You want it the next day really, because you want to see supply demand balance has shifted. It's come back to where it was. It needs to shift again, really kind of 2 or 3 days is pushing your luck. The sooner the better, but again, up to you. Be flexible, depending on the conditions, depending on the scenario. Now, of course, maybe there's a catalyst for this. Maybe this chart is a catalyst that's caused it. But the point is we potentially have got some kind of change in sentiment. This one's a great one because this one is not clean, but it's real world, right? Gold, we've pushed down, we've pushed back up, we've pushed down. We could argue that we're in a downtrend, we could argue an uptrend. I would argue this is not a bad place to be taking it because we've had a move from highs to lows, a kind of month move, or that's not really a month, it's probably 2 weeks worth of move. And we're in an uptrend, so if we isolated this and said, okay, there's an uptrend, we're pulling back in an uptrend, we're kind of undoing a little bit of the uptrend, but not too much. It's not a bad place that we'd normally look for to go long, right? We'd normally look to go long on a pullback in an uptrend. And so this is a perfect example because it's not textbook. The actual the candlestick itself is textbook. This is exactly what you're looking for. This is the candle here. You know, we've got to push the upside. It's an inverted hammer, very, very thin body. The kind of distance between the high and the close is many multiples of that body. It's happening at the low. It's great. But look how it takes a couple of days for it to actually mature and become a decent trade. If you took that on the close here, you're going to get stopped out. You know, it's going to broke through lows. However, if you say to yourself, listen, I only want to take this when we break the high, i.e. here, that's way, way more powerful. Look, you've got to wait 2 days, but look, you can see the strengths coming in. Obviously, this is a great example because it's gone from 12.10 to 12.9. You've got an $80 move on your risk is going to be, you know, very, very slim. And actually, brings me very nicely to the point, where's your risk? You're going to take it as you break through the high, but you're also then going to keep your stop at the low of that signal candle. So this candle here, even though in this example you've gone lower multiple candles before, the point is you're taking it as it explodes through. Your stop is here. It's a very, very decent stop. There's an argument to say you could probably have a stop below the low of that move, and I think that's fair, you know, but I don't think you've got a problem if you're using the low of the actual signal candle. And then targets, you know, this is not going to be a video about targets trailing. The point is the probability of success with this might be low, but the risk reward ratio is quite high, so you're going to be rewarded quite nicely. And of course, the beauty of doing it this way, and you guys will know if you've traded this kind of stuff before, these kind of conditions, is that if you get this inverted hammer and it just rolls over, you're not in the trade. You're not in it because you're waiting for that secondary supply-demand imbalance to shift. You're waiting for that to go long, and then your risk is that or that, depending on how you want to manage it. So it's far more quantifiable, far less likely to be caught in like a brutal downtrend that ends up just being a kind of, you know, a wick to the upside and a push lower. You're not getting caught in that, but you're adjusting it to suit the conditions. You're adjusting it to suit. You're waiting for that second move, which is why it's very different to a lot of the candlestick patterns out there. All right, guys, that's the inverted hammer pattern. You know, let me know your thoughts on that in the comment section below. I think it's one to consider putting in your trading arsenal and integrating into your setups. I hope you enjoyed the video. See you next one. Take care. Bye bye.